Hello traders, it's Tuesday, February the 12th. This is John Kickliter, Chief Strategist for DailyFX.com, here to give you the FX market wrap-up and outlook for the coming 24 hours of trading. This opening 24 hours was somewhat of a correction to the prevailing trends that we had through the end of last week. Some of the more notable moves that we had through Thursday and Friday have seen some significant retracement, while other trends have actually sustained themselves, though we haven't seen a committed drive on either direction. I think that the most remarkable move with momentum behind it was actually gold, and gold's drop itself does not have the necessary catalyst as of yet to continue that bearish trend. We'll discuss that as well as the top FX trends that we had this past session, which are likely to carry over into the following session. Our opening conversation has to be with the Japanese yen. As you can see here with the dollar yen, as through the end of last week we had that nice drop off. I had a short position on dollar yen, looking for this turn to potentially become a full-blown bear trend. But as has been my strategy for a number of weeks now, I'm not going in full size. I'm only going in small size, and I'm waiting until both, or actually all three components of that approach align so that I can actually have a meaningful and trustworthy setup. So I need technicals, which are fulfilled with this short-term trend line break. Although this is only a 2-hour chart, I'd much prefer this larger rising trend as being a meaningful technical break, but nevertheless, the technical break. I need fundamentals, which never really secured themselves. You can loosely run off the expectations that the market is realizing that the Bank of Japan really has not amplified its stimulus policy. If you recall, here is the Fed versus the Bank of Japan's balance sheets, all right, and I normalize it so you don't have the exchange rate kind of snafu in there, and you can see that despite the dollar yen's rise, you haven't actually seen the stimulus that the markets have been expecting, the markets have been pricing in. Of course, if you look at something in contrast like the ECB versus the Fed, it's a very much straightforward correlation. That correlation makes sense, all right? But with the Bank of Japan, you don't have that support. You don't have that fundamental factor in place. And that can be kind of a passive catalyst. It's not really an active driver. The market has to be encouraged to go back and reflect upon this fundamental basis. But in the quiet market conditions, you can absolutely see the markets play to that fundamental assumption. So we have a half and half fundamental theme that supports the dollar yen break, and so is the reason why I actually took my short side, my small short side dollar yen trade. I never had market conditions, though. Market conditions are the third aspect, and that's just reflective of either a market that is good for breakouts and follow through, or general trend development, which is not a good condition for generally FX and capital markets as of right now. But as you can see with the dollar yen, and as you certainly saw in all of the yen crosses, the second half of my euro yen short was trailed out of break even, while the first half actually made its return. So it was overall a decent trade, but the dollar yen's trailed, or actually stopped out, pretty much ate all my euro yen profit from last week. But you can see it from the euro yen, you can see it from the pound yen, had that nice bounce up to the upside. This is a 4-hour chart. You can absolutely see it play out in the higher yielding of the yen crosses, the Aussie yen. Here is the higher time frame for the Kiwi yen. You can see that trend line has held up very nicely. But in general, you saw the yen tentatively make that move lower, and it looked like it was willing to take the technicals, start to play upon the fundamental themes that have been to this point ignored, and work with it. Except each time we have these developments where the yen starts to gain a little bit more traction, it would seem to the conspiracy theorist that policy officials come out of the woodworks and start to really lay out all the threats that they're going to make, escalate their forecasts, suggesting that they're going to do more and more dramatic efforts and an increased timeline. And you're not really a conspiracy theorist if that is your concern, because it actually does, it ends up happening like this each and every time. Now, of course, they're going to have to they're going to run out of ammunition at some point. But for the rest of this week, you actually have something of a problem because come Thursday, you actually have the combination of Japanese GDP, all right, and you have the Bank of Japan rate decision. Those two components together are going to be a major concern, all right. And this past session, we were actually able to ride on non-events, so just commentary. But there was quite a bit of commentary that actually encouraged this move. Three particular name brand people actually pop out. We actually had the economics minister, Amari, who said straight out that he wanted to do as much through the economy as possible to get the Nikkei 225 up to 13,000 by the end of the fiscal year, which is March 31st. So he's trying to drive the benchmark equity index up to 13,000. That is pretty aggressive. That's to target a capital market speculative asset like that and say this is my objective. That is quite remarkable. Of course, from a from a political side, the government can only do so much. All right, they're trying to keep their reasonable budget restraint, and they really can't amplify as much as they would like to. It really falls back to the Bank of Japan. But we also heard that Finance Minister also came across the wire saying that indeed, when he goes to the G20 later this week, and he's the finance minister, so he's going to be in the Friday-Saturday meeting. The deputy finance ministers and central bankers go the Thursday and Friday. But when he goes to the meeting, he's going to say outright that Japan will continue to fight deflation. All right, that's essentially telling the market that those concerned that we would back off of our drive to push the yen lower are sadly mistaken, because we will maintain that bearing, and we will state it very obviously to the fellow policy officials. So removing that aspect. And then really the greatest concern comes from back when a number of months ago when we saw that Abe was likely to get the prime ministership. He was laying out all these threats, and the market was trying to get an assumption of how he would approach monetary stimulus and policy and fiscal stimulus going forward. And they started to price it in. Well, now we're trying to price in who the likely successor is to Bank of Japan and Governor Shirakawa, who is out on March 19th. Well, one of the leading candidates was actually quoted as saying he could actually see stimulus being adopted well before the 2014 target for the 13 trillion yen per month program that has been laid out by the Bank of Japan just recently. So they are escalating. They continue to escalate. You have to be very careful about this. Now, I'm not saying I do think that this needs a correction. All right. The best way of actually securing and actually ensuring a meaningful correction, of course, is going to be something that is more of a catalyst. All right, because you're going to always have these latent threats, and the assumption that the Bank of Japan's balance sheet really isn't keeping pace isn't enough of an active catalyst. If you really want to see a catalyst, you got to go for something like risk aversion, because risk aversion is going to play to both yen crosses that are overbought, severely overbought in the short term, but are also very much built up into carry. And if you're going to hit risk trends, you hit risk trends in the FX market through carry trade interest. And once that starts to drop off, you see the higher yielding differentials like the Kiwi yens and the Aussie yens start to tumble into the fundamentally questionable pound yen and euro yen. And then those pairs that don't seem to have any carry interest like the dollar yen start to pay attention to that as well. Why? Because you have all this yen buying effort, and as they repatriate capital or balance out or offset their positions, that the strong yen demand is going to spill over to this dollar yen, which would otherwise be relatively stable. So this is the primary interest that I have. If you see a U.S. equity index, I use this as my benchmark for risk trends because it is backed not just by the fundamentals for risk reward, which realistically is not, as you can see here from the risk reward index versus the S&P 500. It doesn't reflect the true strength of underlying investment appetite it also reflects stimulus, all right, net stimulus. And if that stimulus confidence starts to come apart, all right, if we start to see expectations for continued escalation of more from the central banks around the world, then you're definitely going to see a stark decline in the U.S. equity markets as a benchmark, as the last bastions, the holdouts for risk trends, and that will certainly spell a significant decline for the dollar yen. Now, in the meantime, the euro dollar, the other major dollar-based currency pair, is running on the same underlying assumption that it is watching those underlying fundamentals, but in fact, the underlying fundamental aspect of the euro dollar actually supports continued euro-dollar move to the upside. And the underlying consideration goes, once again, back to that comparison of relative stimulus. The ECB continues to withdraw stimulus from its system while the Fed continues to add to it. So it does give that very substantial push to the upside. Alternatively, you have a number of standalone issues. You have event risk this week that can significantly alter the course of confidence in the European financial situation. Now, we had that opportunity in this past session. The event risk calendar, or the Manic Crisis calendar you see here, one of the top events was the Eurozone Finance Ministers meeting in Brussels. The topic of conversation was all the hot topics. Okay, we had a discussion about the Cyprus rescue. We had a discussion about Greece's progress. We had a discussion about Ireland and Portugal and what their financing would be given their progress. And what was going to be done about using the ESM, the European Stability Mechanism, as a direct bailout for troubled banks. All right. Those are the four big topics that really hone into the underlying financial stability of the Eurozone. And each one of those topics, they essentially said, you know what, we're going to talk about it in March. We're not going to talk about it here. All right. Saying they're not going to talk about it until March means that also tomorrow's European Union finance ministers meeting, all right, so the bigger union, not just the Eurozone, is probably going to pass without meaningful influence as well. All right, you don't expect a strong bullish push from that event, but at least it wasn't a negative event on that aspect for the Monday session. Far more interesting was some commentary that came from a couple of central bankers, Asmussen, through the weekend, but more importantly, we actually had one of the more conservative ECB members, in fact, the head of the Bundesbank and ECB member Weidmann, who said that the euro was, in fact, not significantly not seriously overvalued. Right? It's not the same thing as saying the euro isn't high, it can continue to advance, and it should. Go ahead, go for it. But it does have that sense, because we do have some contrast with the Eurozone finance minister, who actually suggested that the Eurogroup has to have some kind of FX policy because they want to try to step into the manipulation game, the currency war game. Well, the ECB is pushing back. They don't want to get involved with this. They don't want to be influenced like the Bank of Japan is by the Japanese government. That is a very big support for the euro. Once again, it confirms the same thing we saw with those currency war charts, that the ECB is still withdrawing stimulus. It's actually in a tightening regime, which raises rates and makes the euro more attractive. And that is a fundamental aspect that can keep the euro advancing. All right. Now, of course, there is a very immediate concern that if you have general risk trends step in, the euro dollar is going to break. The euro dollar can easily break 132.50 if risk trends seriously start to break down on U.S. equity markets. So I'm watching these U.S. equity markets like a hawk, because they will give you some clear guidance on what to expect going forward. And a couple things that you have to understand about this past session. Look how inactive the markets have become. They've lost momentum, they've lost directionality, but they also have shown a significant contraction on activity. In fact, you've had a less than 5 point range, daily range, this past session, this opening session this week. And you haven't had many of these going back to the beginning of 2008. You've had a number of them actually in the slow progress that you had through 2010, 2011, but you're really not seeing the progress as of right now. It's more contraction, congestion. Furthermore, participation measured in volume has also shown a significant drop-off. And what I did here is all volume days that were less than 450 million shares per day would be included in here. A lot of this is actually holiday-based volume, like this. These two instances here would be Thanksgiving and the Christmas holiday. Same with this. Same with this. Same with this. We've had an increasing amount of low volume days in these more recent pushes higher. All right, that is very, very interesting. And net, if you look at the general trend, the volume figures are at essentially their lowest levels in 15 years. These markets are growing exceptionally, exceptionally quiet. Doesn't mean necessarily immediate reversal. All right, it hasn't been a reversal as it's trending that way for the past months, but it does leverage the risk, and we should be very, very careful about our assumptions with risk trends going forward. Now, what does that mean for euro-dollar trading? I am not necessarily going long. I do think that the fundamentals, the underlying fundamentals as they stand right now, still support the euro, and I'm not concerned, or I'm less concerned now about what the EU finance ministers meeting holds in the upcoming session. But I'm also concerned about a few things like Prime Minister Rajoy's for Spain meet with Draghi. I don't know what that's going to entail, and I don't want to take any risks with it. But more importantly, I'm much more concerned about Thursday's GDP figures. I don't want to mess around with that. When you go into major event risk, you often have markets that quiet down and don't provide direction ahead of meaningful event risk. So I'm taking a very cautious approach with that. Now, an interesting, getting away from the euro, getting away from the yen crosses, where you can still find risk-based assumptions. Here you have the Aussie dollar, very interesting, continues to push down at a measured pace, but nevertheless it continues to push down to 5-week lows. We have, or 4-month lows. You can see that we are moving closer and closer to that 150 level, 101.50. And that is a meaningful support to the range that goes all the way back to July of last year. So a very interesting look on risk trends where you have something like the euro dollar, which has sustained its upside trend, whereas the more explicit risk and carry trade in the Aussie dollar really has not shown the same measure of appreciation. Kiwi dollar is starting to fall into the same lines. Very interesting. If Kiwi dollar breaks below this 82.50 level, or just this trend line and 100-day moving average, I'm going to be considerably more interested in this currency pair, but right now I'm biding my time. I'm waiting to see what happens. Of course, if there is a continued risk appetite move to the upside, it's also a range opportunity. So considerable interest on both sides of this pair. Now, a very, very interesting pair, and I think one of the most attractive technical setups for right now is the pound dollar. If you look at the cable on a daily chart, you see that 4-year trend line. That's the bottom of that wedge for that over that time frame. We came right back down to it. It took 2 days to advance as far as the pound dollar dropped just on Monday alone. We were back to that trend line low, testing those range lows that we had through middle of last week. On one hand, I like the technical picture. I think that the technical picture says, yes, this has a good chance of breaking to the holding that range and moving to the upside. But you have to be very careful because you have event risk coming up that can significantly alter this pair's course. One, you always have the opportunity of risk aversion. Of course, it's not an active catalyst, and it hasn't been as of yet. But from a more fundamental standpoint, if you look on the Minute Crisis calendar or on the Daily FX economic calendar, you actually find that the CPI figures for January coming up. I don't think these carry a very high level of influence over market activity, but Wednesday's top event risk for the pound does, the Bank of England inflation report. And between now and Wednesday's release, not a lot of time, and the market, as I said earlier, will typically really level off and not take to meaningful trends if there's major event risk that the market's going to be concerned about. in the foreseeable future. And that's going to definitely be a problem because we have building speculation that the Bank of England is going to soften its outlook, that it's going to lower its growth forecast, that it's going to have a more conservative approach to the fiscal health of the region, and that in turn can lead to more easing, more stimulus. And if that's the case, that would weaken the pound. Is it a high probability? It might not be, but I don't want to add to that risk and go long pound dollar just yet. I am still actually short on the second half of my euro pound odyssey. I traded to the downside on this range here, and now I'm short again from just around the upper threshold of this break here. But now I want to see if there's going to be some continuation here. But the euro and the pound side of things are getting complicated, so I'm not going to add with the pound dollar exposure. Now I said I'd also discuss the gold market, and I will. This is how we're going to wrap up. Through the end of the last week in the daily fundamentals I wrote, I said that there's very high probability that the gold market would actually see a breakout sometime this week. I did not think that it would be this early, especially with the lack of genuine trend development that we had the opening 24 hours. Nevertheless, that really tight range, that congestion pattern, led to a meaningful break. This is a good argument for those traders that say, I only need fundamentals. That doesn't always work. All right, technicals and more importantly, market conditions, a third and often overlooked aspect of this market, was the general driver of this particular move. It was the impetus for the breakout. This move to the downside certainly mirrors the dollar strength. If you look at the dollar index, the Dow Jones FXCM dollar index, it actually showed a significant rally to its highest levels in over 2 years. That strength and the fact that the European officials said that they don't think that the currency is overbought or overextended was another condition that says no more stimulus is coming from the Eurozone. And net, that has a negative impact on gold's performance. We are at a more significant technical level now. You can see that this has been a rise. This is a rising trend line support. All right, I don't put too much stock into it. It has 1, 2, 3 major tests of support. I need 3 to actually generate a support, so it's only one step into a actual confirmation and test. But that 1640 level is generally very important. You can see that it loosely set the reversal here, loosely set the reversal here. So if you want to see continuation, we have to break that trend line. That's going to be a first good step. That can be your line in the stand that you use if you're looking for bearish progress. But gold itself was perhaps the biggest driver on the day, and we need to watch very closely the assumptions and the discussions of currency war. The G20 meeting that we have later this week, that is really going to tap into a demand for an alternative to the traditional currency market, all right, traditional fiat assets as they call it. If the currency war looks like it's stoked and they're not going to be able to prevent it, watch a lot more capital actually be diverted to something like gold. Alternatively, if it cools off, gold's appeal as an alternative store of wealth is going to drop off, and you can very well see a drop back down towards these 1525 levels that were the range low going all the way back to 2011. So keep a close eye on these markets. As always, your most immediate risk is going to be risk trends. If risk trends break, you have a significant movement on your hands. In the meantime, if those risk trends don't develop, watch very closely the euro dollar, watch very closely the yen crosses, and for specific event risk, it's going to be an interesting day for the cable, or actually an interesting 2 days as we hit the event risk. Keep your eyes peeled. There's a lot of volatility. As of right now, we're still not getting consistent underlying currents, underlying trends, but you still have a lot of short-term volatility, which can lead to short-term trends. Good luck trading out there, guys, and I'll update you for the next round of major event risk tomorrow.